Roomba's vacuum maker, the
robots to really take care of their floor care, and so we keep raising the bar.
iRobot filing for bankruptcy.
Vacuum the Roomba, yeah. So its shares really taking a hit down more than 80%. It filed for bankruptcy.
In early 2021, iRobot looked unstoppable. Its flagship product, Roomba, wasn't just a best-selling robot vacuum. It was the name of the category itself. Much like Google became synonymous with search, people used Roomba to describe any robotic cleaner. For competitors, that level of brand dominance was intimidating. For iRobot, it felt permanent. At its peak, the company controlled nearly 3/4 of the global robot vacuum market. Margins were high, customer loyalty was strong, and the Roomba brand commanded premium prices, often hitting $900 per unit. Investors thought iRobot had built an unbreakable fortress, protected by patents, brand power, and years of technological head start. Its valuation crossed $5 billion, and the stock hit record highs. But here's the catch: dominance often breeds complacency. While iRobot enjoyed its throne as market king, the world beneath it was quietly evolving. Consumer expectations were changing, supply chains were globalizing, and innovation was accelerating far beyond Silicon Valley. Roomba was winning the present, but slowly losing the future. iRobot's story didn't start with home cleaning. Back in 1990, 3 brilliant roboticists, Colin Angle, Helen Greiner, and Rodney Brooks, founded a company called Robotics at MIT's Artificial Intelligence Lab. Their early focus? Machines built for dangerous environments, not domestic ones. For nearly a decade, iRobot worked as a defense contractor. One of their most famous creations was the PackBot, a rugged, tank-like robot deployed by the U.S. military to detect explosives in Iraq and Afghanistan. Technologically, it was impressive. Commercially, it was unsustainable. Military orders were small, irregular, and never enough to cover massive research and development costs. Here's the pivotal moment. In 2002, iRobot realized they needed volume, not niche brilliance. They took the advanced navigation from military robots, stripped out the expensive sensors, added a vacuum motor, and launched the Roomba, a $200 robot designed to do one simple thing: clean floors so humans didn't have to. Industry veterans scoffed. "It's a toy," they said. But iRobot had spotted a key truth. People don't need perfect cleaning, they need convenience. And let's face it, nobody enjoys vacuuming. Roomba didn't just sell, it exploded. By 2004, over 1 million units were flying off the shelves. By 2010, Roomba became a pop culture icon, appearing in TV shows and ads. Competitors? They hadn't caught up. iRobot built an almost unfair advantage on 3 pillars. First, intellectual property. Over 1,500 patents on navigation, docking, and movement. Competitors weren't just battling tech, they were facing lawsuits. Second, brand dominance. Roomba sold itself. Less advertising, higher prices, and competitors couldn't touch it. And third, data mapping. High-end Roombas mapped users' homes, layouts, furniture, square footage, creating the backbone for future smart homes. By 2017, iRobot controlled over 60% of the global market and was printing money. But here's the kicker. They assumed their approach would always be the best. Competitors were about to prove them wrong. For years, iRobot believed their biggest threats would come from American or European tech firms. That assumption? Fatal. The real disruption didn't come from Silicon Valley. It came from Shenzhen, China. Around 2016, a new wave of competitors entered the robot vacuum market. Companies like Roborock, Ecovacs, and Dream weren't producing cheap knockoffs. They were building technologically superior machines at aggressive prices. From a competitor's perspective, this was the moment the industry shifted from innovation to optimization. Here's the core battleground: navigation systems. iRobot had bet big on vSLAM, a camera-based system letting Roombas see rooms. Smart? Yes, but it had problems. It struggled in the dark, needed heavy processing power, and often failed around cables, mirrors, and reflective surfaces. Meanwhile, Chinese competitors chose LiDAR, laser-based mapping that worked instantly in any light, created precise maps, and used less computing power. As LiDAR sensors got cheaper, these companies could undercut Roomba's prices while offering better functionality. And that's not all. They added features iRobot couldn't match. Robots that vacuumed and mopped simultaneously, self-washing mop systems, auto-empty stations, app-controlled room zoning, and the kicker? Prices were often $200 lower than Roombas with fewer complaints. From a consumer perspective, the value equation broke. Why pay $900 for a camera-based Roomba when a $600 LiDAR robot did more? iRobot's business model depended on premium pricing. Once that premium collapsed, everything else unraveled. In 2017, Shark Ninja entered the market. Their robot wasn't revolutionary, just good enough at half the cost. iRobot did what it always did: lawsuits. But this time, legal pressure failed. Shark captured nearly 20% of the market almost overnight. Brand loyalty couldn't survive that price gap. By 2022, iRobot's financials were bleeding. Revenue was falling, inventory piled up, and market share slipped every quarter. Cutting prices would destroy margins. Maintaining them would continue losing customers. Either way, pain was inevitable. At this critical moment, iRobot looked for an exit. In August 2022, Amazon announced a $1.7 billion acquisition deal. On paper, it was perfect. Amazon wanted iRobot's home mapping data to boost Alexa. iRobot needed Amazon's deep pockets to fight the Chinese giants on price. Investors cheered, stocks surged. But here's the problem. Regulators, the US Federal Trade Commission and the European Commission were wary. They feared Amazon would prioritize Roombas in search results and gain unprecedented insight into consumers' homes. For 18 agonizing months, iRobot was frozen in limbo. They couldn't slash prices, restructure, or make long-term investments. Meanwhile, Roborock and Ecovacs didn't wait. They flooded the market with better, faster, and cheaper models. iRobot's sales collapsed while lawyers debated antitrust concerns. In January 2024, the hammer dropped. The European Commission blocked the deal. Amazon walked away, paying a $94 million breakup fee. Pocket change for Amazon, catastrophic for iRobot. The stock crashed nearly 50% overnight. When the Amazon deal collapsed, iRobot's problems went from serious to existential. Years of slipping competitiveness had already weakened the company, but losing its last financial lifeline, that was the final blow. During the pandemic boom, iRobot had overproduced robots, betting that demand for home automation would remain high. That gamble failed spectacularly. By 2024, warehouses overflowed with unsold Roombas, cash reserves were shrinking, and debts were coming due. Without Amazon's backing, iRobot had no cushion to absorb losses or fund the next generation of products. The response was swift and brutal. In early 2024, iRobot laid off 31% of its workforce, over 350 employees, including many from software, AI, and core innovation teams. The founder and CEO, Colin Angle, stepped down. His departure wasn't just a leadership change. It symbolized the end of iRobot's original vision, a company driven by robotics excellence rather than survival. With options running out, iRobot made a move that would have been unthinkable a decade earlier, outsourcing R&D and manufacturing to China, to the very supply chains that had undercut them. The pioneer of home robotics had become reliant on the competition. By late 2025, the situation was irreversible. Sales continued to decline, debts matured, and investor confidence evaporated. In December 2025, iRobot filed for Chapter 11 bankruptcy protection. The plan wasn't to turn things around, it was an orderly exit. iRobot's remaining assets were acquired by Paikia Robotics, a Shenzhen-based manufacturer already producing components for Roomba devices. From a competitor's viewpoint, the symbolism was staggering. An American robotics icon, now a brand within a Chinese supply chain. Consumers immediately raised concerns: software support, cloud connectivity, and device functionality if servers were shut down. Trust, once Roomba's greatest asset, had eroded. Despite selling over 50 million robots worldwide, iRobot couldn't escape a hard truth of modern hardware markets. Innovation without cost efficiency is temporary, and brand power without adaptability fades quickly. Roomba didn't fail because robots were bad. It failed because the market outgrew the company that created it. The downfall of iRobot isn't a story about bad products. It's about what happens when early success is mistaken for permanent advantage. Roomba succeeded by inventing a category, patenting relentlessly, and charging a premium. But as robotics commoditized, sensors cheaper, supply chains globalized, competitors faster, that same premium model became a liability. Chinese manufacturers broke the price barrier. Companies like Shark showed that good enough often beats best. Regulators blocked the only viable exit strategy. iRobot, frozen in transition, lost the ability to respond. Yet Roomba's legacy is undeniable. It placed autonomous machines in over 40 million homes, changed consumer expectations, and forced every major electronics company to take home robotics seriously. In the end, iRobot didn't lose because it failed to innovate first. It lost because it failed to innovate fast enough against competitors who had learned from its success. Roomba built the future of home robotics. That future simply moved on without it.